What if I told you that the Federal Reserve cutting interest rates could very well result in the interest rates of long-term debt soaring much higher? Not only is this possible, but I think it's actually the most likely outcome here. And to understand why, we have to start by looking at which interest rates the Federal Reserve actually controls. For those of you who don't know me, my name is Joe Brown. I'm a former stockbroker who spent years teaching the top 1% how to manage their wealth. After making enough money to leave the corporate world behind, now I focus on teaching anybody and everybody with ears to hear financial strategies that exist outside of the mainstream, things that you'd never hear from a financial advisor. If you're interested in working with me, stick around. I'll tell you more about that at the end of the video. Most people have no idea what interest rates the Federal Reserve controls. In fact, you talk to your average home buyer or real estate agent, the number one thing that they've been talking about for about 2 years now is just wait for the Federal Reserve to lower interest rates so you can get a lower mortgage. But here's the thing. The Federal Reserve does not control mortgage rates. They don't control any interest rates on debt that is 30 years out, let alone 20, 10, 15, 5 years out, even 1 year out. They don't even control or directly influence any interest rates on any debt set by the private market whatsoever. They control one thing and one thing only, which is interest rates on cash held by banks at the Federal Reserve overnight. That's it. Now, there's obviously some nuance here because their intervention in bond markets does have an influence on interest rates for the government's borrowing costs. For instance, during 2020, when the Federal Reserve was buying up trillions of dollars of government debt, obviously that pushed down interest rates on all of the government debt that they were buying, which allowed the government to borrow from the Fed at very cheap interest rates. But exerting a force and setting an interest rate are two very different things. And the only interest rate as of right now, as long as we don't have yield curve control, the only interest rate that the Federal Reserve actually controls is the Fed funds rate and the other associated overnight rates held at the Fed. So right now, the federal funds rate is about 5.3%, which is a great amount of money for anybody like a bank who has just a few billion in cash laying around that they need something to do with that's risk-free. They shove it over to the Fed and get paid a risk-free 5.3 to 5.35%. So what is the effect of the Federal Reserve changing the one interest rate that they do control, this Fed funds rate? Well, many times it will incentivize those financial institutions to go do something else with their cash. That's right. Right now, by keeping interest rates high, the Federal Reserve is directly incentivizing financial institutions to not do anything productive with their cash. They're keeping their cash, or some of you will point out that it is reserves, with the Fed so that it's not out in the economy doing anything productive. The way that banks are incentivized to do this is to get paid billions upon billions and billions of risk-free dollars just to make sure you can't get a cheap mortgage. How do you like that? So obviously, if the Federal Reserve takes this interest rate from 5.3%, let's just go extreme all the way down to 1%, all the financial institutions will say, man, well, we don't want to get 1% anymore, so we're going to take all of this and go do something else with it. We're going to loan it out to somebody else instead, who's going to pay us a better rate. And those loans are going to be made primarily to other institutions or individuals who are going to be going out and using it in the real economy. A lot of it will also be lent to the government, who then spends it, and that money again circulates into the real economy. But this is where the plan starts to break down, because as you can see here, there's a bunch of reserves locked up out of circulation. If the Fed lowers interest rates, at least some of that money will start recirculating through the economy again, which will obviously have an upwards pressure on prices, reigniting inflation. Not to mention the fact that if the Federal Reserve cuts interest rates, they are telling the world they are done fighting inflation. And inflation has not been defeated yet. Remember, with inflation, we're talking about the rate of price increases. We're not talking about the absolute level of prices. So you can kiss goodbye those 2019 prices that some people were still hoping would come back around someday. Prices will never get back down to that level ever again unless we see a deflation of the money supply, unless we see a contraction of the money supply. In other words, a deflationary death spiral, which we probably will not see. Therefore, prices will continue to go up. The Fed just wants to make sure they're not going up at a pace that people notice. And that's the big problem here, because if they lower rates, they're signaling an end to their fight against inflation before people stop noticing it. So why is that a problem? Well, it has to do with the long-term bonds that we were talking about earlier. When you lend money to somebody for 10 years, 20 years, 30 years, you want a reasonable expectation that you're going to get that money back. Now, something might happen and you might not get that money back. And so you're going to charge an interest rate for that risk. By the way, you could be doing something else with that money. So you're also going to charge an interest rate to be compensated for the opportunity cost of everything else you could be doing with that money. Now, when you factor in to the equation the fact that prices are also going up during that time, you have to charge an even higher interest rate so that you're compensated for your loss of purchasing power along the way. Because if you lend 10 grand right now and you get 10 grand back in 10 years, but prices have gone up and the stuff you used to be able to buy with 10 grand now costs 15 grand, you've lost a bunch of money in real purchasing power terms, even though you got your original 10 grand back. So you're going to be compensated for your risk, you're going to be compensated for your opportunity cost, and you're going to be compensated for the fact that prices are rising. So what do you think the lenders of long-term bonds will do from the Federal Reserve throwing up their hands and saying, we're done fighting inflation? They're going to demand a higher interest rate. 30-second crash course here on the way that bonds work for anybody who's not familiar. Price of the bond and the interest rate on the bond is inversely correlated. If I lend you $100 and get $101 back, my yield, the interest rate, is 1%. But if I lend you $100 and I'm like, well, shoot, I need that $100 back now, I'm going to sell that contract to somebody else so that you owe them money instead of you owing me money. And let's say I can't get full price for it, so I sell it for $99. Well, you still owe that person $101. So their yield is 2%. The price of the bond went from $100 to $99, but the yield or the interest rate went from 1% to 2%. Prices and yields are inversely correlated. So when long-term bond lenders, long-term bond investors look at the Fed and see you're no longer fighting inflation and they want to be compensated for that increased loss of purchasing power along the way, they're going to demand a higher interest rate, which is the same thing as saying long-term bond prices fall. And they fall because those long-term bond investors sell those bonds up because they're not worth as much anymore. So debt that matures in 5, 10, 20, 30 years crashes while the interest rate or the yield spikes. Now, if you're tracking with this, you're probably in your mind visualizing something like this, which is the yield curve. Currently, the yield curve is inverted, which means the debt at the short end of the curve that matures in maybe a couple of weeks or a couple of months is at the highest interest rate. And the longer you go out in time, the lower the interest rate gets. This is abnormal and rarely, if ever, happens in a free market and always signals a coming recession. But what most people are unaware about the inverted yield curve here is that the recession normally happens after the yield curve normalizes, or in other words, it uninverts or steepens. Once you see the yield curve go back to normal, the countdown to the recession begins. So by the Federal Reserve cutting interest rates, they're affecting directly only the short end of the yield curve, pushing it back down. At the same time, the impact on the rest of the market will push interest rates higher, which means the yield curve uninverts, goes back to normal, triggering a recession. In case you're brand new to the channel, I've made a ton of videos about this, but we are in a long-term debt cycle here that so far has been about 40 years for every phase of the cycle. From 1940 through 1980, both interest rates and inflation were rising for about 40 years. They peaked out in about 1980 after the big boom of the 70s, going out with a bang there from delinking from gold. And for the next 40 years from there, interest rates and inflation both fell for 40 years. They bottomed out in 2020. We have turned that corner again with inflation and interest rates both headed higher for the new phase of the long-term debt cycle. And this right here that we're seeing play out is part of that flywheel that will keep interest rates and inflation headed higher for the long term. The Federal Reserve lowering interest rates right now is pushing cash out into the economy. The Fed is surrendering their fight against inflation. This is going to drive prices higher. When prices go higher, interest rates on all other debt goes higher to compensate. And the only way to stop that spiral is for the Fed to step in and buy some of those bonds that are getting sold off, which again only increases the amount of money going into the circulation, driving up prices, making the problem worse. These short-term moves by the Fed to cut interest rates are not indicative of the long-term cycle changing. There's volatility on the way, but we are in a higher for longer stage. And if you're looking for a way to profit from this situation, I want you to save a date coming up very soon here on your calendar, August 15th, 7 p.m. Eastern Time. This coming Thursday, I'm hosting a live masterclass where I'm going to be covering one of the best kept secrets in all of finance, the asymmetric trade. These types of trades have been used by the brightest minds in all of finance, people like the Big Short investor Michael Burry, Black Swan author Nassim Taleb, billionaire hedge fund manager Bill Ackman, and plenty of others. I've personally been using this strategy in my own account over the past year to take home some very impressive returns, and I plan on sharing everything I know with you at this event. The next 3 months will present massive opportunities for asymmetric trades, and if you want to profit from that, you've got to be getting into position for it now. I'm going to show you an easy and simple to follow protocol that I use for spotting these asymmetric trades. It's a system that I've used to take home massive gains in my own account and that you can use to spot asymmetric trades for yourself. I'm going to share with you the exact techniques that I've been using with a small group of beta testers, spot some of their own asymmetric trades over the last few months. I'm going to show you how you can use these trades to profit from major geopolitical events. This event is completely free, but spaces are limited. In fact, last time I hosted one of these masterclasses, we had more people register for the event than could actually fit on the Zoom call. So if you're interested in attending, sign up now, save the date, and make sure you show up early. To sign up, click on the link in the description below, put in your email, and I'll see you there. As always, thanks so much for watching. Have a great day.